I'm based in the US, so good morning from here. I'm still enjoying my coffee and trying to wake up a little bit, but I know that we've got folks all over the world, so a good afternoon and a good evening as well. My name is Matthew Schneider. I am the president and CEO of a company called Building Inc., and we've been focusing on data management and tokenization for quite a while. But we're also focusing or working to establish a digital standard for real estate. And I'll dive into what that looks like. I call it a meta protocol throughout the presentation. We'll cover what's happening in real world asset tokenization. Again, there's going to be some overlap with previous presentations in terms of the news because it's global at this point. We're all looking at the same headlines. We'll dive into why asset data and some of the more structural data carries more economic weight than what we're currently giving it, and then how the built environment starts to behave very, very differently once its information can move very fluently. As soon as real estate information and value starts moving at the speed of the internet, and as capital markets move at the speed of the internet. We've got a couple use cases towards the end that we'll dive into as well. Let's take it away. So, starting with the elephant in the room, the third quarter of 2025 has been net negative, I think, for RWA. And a lot of that is public perception, but that's extraordinarily important in the grand scheme of things. That was recognized the other day when I was talking to asset managers and bankers and controllers through this top 5 accounting event. And even if the underlying technology is there, how they perceive it and its reliability influences whether or not they're going to be quickly adopting it. So we've had the retracement of Bitcoin, several high-profile tokenization projects hit pause, and then some international bodies stepped in with criticism. We had the International Organization of Securities Commissions, which began flagging risks that arise specifically from tokenization. They had opaque ownership claims, spillover effects from volatile crypto markets, and then they believe that the efficiency gains are not evenly distributed. At the same time, we had Beijing intervening in the Hong Kong stablecoin markets because there's a lot of unease with handling privately issued or privately controlled digital currencies. So everyone's sort of wondering what happens next at that point. Now, one positive note is that the number of assets on chain has never been higher. But there is the projection that we're supposed to hit 13, 15, 20 trillion US dollars of assets on chain by 2030, and we are at 1/1000th of that scale. So how do we start to unlock that? For us, the answer lies in data, price discovery, and real use cases, which is what this presentation will unfold. This all throughout the keynote should offer a clear sense of how tokenization can be used strategically and how data becomes the anchor that links the trillions of dollars sitting in traditional finance to the emerging digital markets. To see why that matters, we have to look honestly at what's dysfunctional in real estate and in the private markets that surround it. The first issue is that real estate is, by design, asymmetrical. And I say by design because arbitrage is a huge portion of how people capitalize in real estate. Information does not flow evenly, and in many cases, there are financial incentives for not doing so. A contractor who's going to cut corners to reduce labor hours gains more than one who follows codification to the letter, assuming no repercussions. A broker who admits a structural flaw can preserve a higher price. And over time, the remedy has been to layer on audits, consultants, and intermediaries. These are necessary, but they create cost, and they can be punishing when they surface underlying issues where there was not disclosure in the first place. So my focus here is on how these kinds of malfunctions appear in capital markets, in private markets. For example, with asset managers who can go 6, 12, even 24 months without real reporting, offering perhaps a speculative trailing NAV to delay the underwriting or rewriting their books. And when that happens, we lose both data and valuation integrity. And at that point, the entire structure operates like a house of cards resting on a foundation of sand. So the obvious solution is that development firms need to treat data as an asset and manage it the way they manage anything else in a portfolio. There's a range of software and workflow automations that capture data across design, construction, and operations. But what we've learned, especially when dealing with institutional groups, is that being data rich is not enough. Data has to be verified, and that becomes non-negotiable at scale. If you and your team are spending 80 to 90% of your time collecting data and you're not creating value, you're creating liability, because whatever you collect ultimately has to be verified by someone else, a counterparty, an auditor, a regulator, or an oracle. The intuition that more data is better doesn't actually hold up across the asset lifecycle. More data only matters if it can be trusted the moments that it enters the system. And this is where blockchain begins to matter. If data is attested at the point of entry, timestamped, signed, and anchored on chain, you prevent the inevitable re-evaluation and dispute that surfaces months later, months or years later, right down the line throughout a property's life cycle. So the mechanism that allows this is data provenance. It gives you the immutable answer to three basic questions: who created the data, when it was created, and under what conditions. The larger point is that data architecture is often more important than the data itself. This is where the industry, in my opinion, has gone off the rails. Early trailblazers of tokenized assets had no data behind them. Then the next wave worked with listing pages and some basic oracles, but the underlying information still couldn't be verified, preserved, or reactivated for new valuations or risk assessments. And that's exactly where institutional capital is stepping away, because they need internal controls and auditability, a depth of comparables. Otherwise, these assets just get terrible accounting treatments and they're untouchable. Going a step further, data provenance matters, but provenance alone doesn't create valuation insight. So we need the architecture of the information, the categories that actually influence risk, performance, and value, capturing those and getting those on chain. In real estate, these categories are fairly consistent. I list them in front of us, right? We've got design integrity and structural condition, operational performance, environmental exposure. We've got market benchmarks, certification, data completeness. But this is the point where data becomes contextualized. Raw data evolving into information, and that information informs valuation, pricing, collateralization, and liquidity. There's other inputs that matter, of course: market comparables, lease structures, tenant quality, cap rates. But for this discussion, I'm focusing on the categories within the property owner's control, because that's what they're responsible to document, and they're underutilized in valuation models because they can't be reliable. So we're making that reliable, and they can be properly utilized in valuation models. And it's, I believe, the right place to focus for this audience, because a lot of it does tie back to the C in CBC, which is construction. Where does the information come from? For design integrity and structural condition, we know it starts with BIM. It doesn't change the valuation, but it's a system of record. And that's the bleed over into golden thread, which as Americans, we don't really utilize. So I would be claiming expertise in a realm that I don't have to really dive into all the fantastic utilizations of a golden thread BIM. But for operational performance and maintenance truth, sources are digital twins, IoT, FM systems. We have environmental exposure. But the data completeness and lineage from all the provenance systems, this gives us like a meta layer that tells us that the information itself can be trusted wherever it's coming from. And when all of this works in alignments, you see the rails set up to carry capital and to move at an unprecedented speed. So information coming from, and now information application, and this is where it gets very exciting, right? We finally get to tokenization. So we've mapped the information sources, but this is where the information can actually be used in capital markets, and this is what's unprecedented. So tokenization is sitting above the data layer and above the valuation layer. To me, I call it the financial interface, or for us, we call it the financial interface, and it's a bridge between information and the people, institutions, and the capital that have to actually act on it. The way that I tend to frame it is that if you have a valuation sitting in a spreadsheet, nothing inside that sheet can turn that number into cash. There is no sell button. And there's no mechanism for rebalancing portfolios or adjusting reserves. what typically happens is that the numbers get circulated, intermediaries will touch them, and then after a couple of months, someone will produce a bid. But tokenization completely changes that. It's a record of verified data and a financial instrument. It's not just a hypernotary for transaction authentication, but it's a container for realizable value. Inside that instrument is the verified data, the valuation model, and the rules of transfer. And because that smart contract is programmable, the instrument can respond in real time as new information enters the system. For institutions, this is a turning point. Tokens enable continuous mark to market. They let collateral values adjust dynamically. They would allow buy, sell, recall, and reallocation, all based on extraordinarily data-rich, data-verified environments. The data rooms, digital twins, appraisal logic, and waterfall models that we were talking about. And this also gives us visibility. It accelerates how quickly counterparties can generate bids and execute trades with confidence aligned to their risk and reward parameters. And roll credits, this is where property becomes protocol, which is the title. For something to be a protocol, let's touch on that real quickly, not to be confused with just the blockchain protocol, although the first principles are the same. We have a shared set of rules of how information is structured, verified, and transferred. Capital markets are sort of working the same way, right? There's accounting standards, disclosure frameworks, and custody rules. These all establish order, comparability, and trust. But as we tokenize real estate, there has to be a meta protocol, or the digital standard as building knows it, that's being established and describes how these financial instruments should be constructed. For example, what data needs to be included, who is authorized to attest it, how transfers settle, and what rights and obligations travel with the ownership. And then deep down, there is the blockchain protocol, the smart contract as well. But it sits above the information layer, has its own rule sets and governance. But this is how tokens become legitimate financial instruments that can be used in capital markets. And then some of the use cases that I'm going to share in a moment here. Before we dive into that, let's just recap. So real estate and infrastructure today is opaque, ambiguous, and trapped in capital markets. Documentation and reporting requirements are minimal, which lowers upfront costs, but it also limits investor participation and increases scrutiny from lenders. The punishment for poor or missing data is very harsh. Higher cost of capital, higher collateral requirements, valuation discounts, illiquidity premiums, wider bid-ask spreads, and strict limits on solicitation and transfer. But when you build genuine information infrastructure and when the data is auditable, those penalties start to disappear. First gradually, and then suddenly, especially if you can reclassify the assets under GAAP, ASC, or FASB standards. When the inputs are audible, assets are priced frequently and transparently, and then there's access to equally qualified comparables. These assets can attract bids, they can be used as collateral, they receive favorable accounting treatment, and then they trade. And beyond trade, we're going to see very exciting things like indices, derivatives, and new financial products. So first use case is simple. When we make real estate data rich and data verified, it becomes more attractive to institutional capital. Institutions can move capital into asset classes where they can trust the marks. And then what they're really looking for is a series of marks that form a trend, not just a one-time appraisal. Today, these private markets hold around 300 trillion US dollars in value, but a lot of that capital sits idle because data opacity prevents mark-to-market treatment. The accounting systems cannot price what they cannot verify. But when verified, continuously updated data streams from BIM, digital twins, oracles into a valuation framework that's verified, institutions can treat that private real estate like a marketable alternative. Bid-ask spreads narrow because data becomes more symmetrical, accounting treatment improves, reserve requirements drop, Basel classifications become more favorable, and allocation to real estate increases. Next, super intriguing use case for the AECO community. I've had multiple conversations about the lack of accountability in architecture, engineering, and construction. I believe one other speaker is touching on this as well. There's very limited buy-in from stakeholders, especially in early stages of a project. You've got your architects, engineers, and contractors who are paid up front regardless of how much progress is actually made. I had an architect joke to me that the best project is the one that never begins. There's two ways that we can start to fix this. The first is to introduce a financial instrument, one that's redeemable for cash value and offered as a partial offset to compensation. And in doing so, you're giving these AEC professionals exposure to the long-term appreciation of the asset they're helping to build. Should be done in a tokenized format. And then, of course, this is only possible if the project is being continuously marked. But as we discussed with BIM, digital twins, and all of the data architecture, the information infrastructure, that is certainly possible. And then the second approach is to structure payment releases through smart contracts, which I believe there's been more conversation about. But it aligns incentives across the value chain, and it encourages higher data and work quality, and could lay the foundation for marketplaces of intellectual property. The former concept and this next one were actually brought to me by Ralph Montag, who runs the BIM Coordinator Summit in the BIM Heroes community. I was captivated by the idea of a dynamic investment tranche based on a project's actual progress. Typically, project finance is binary. You put money in at the start, and then whatever happens. Investors enter through common or preferred equity, sometimes through mezzanine or private credit funds lending to the development. But technically, every layer of that capital stack carries the same risk on day one. And that's very uncomfortable for investors. So a potential solution is to break those tranches apart, subdividing common or preferred equity into smaller slices that open for investment as the project advances and risk declines. Each tranche would correspond to some sort of verified milestone. To make this happen, you need real-time appraisal. So information coming in, documentation, financials, BIM, digital twin updates, all feeding into a valuation engine. And then that engine calculates the project's adjusted asset price, very importantly, with risk reductions baked in. And then this triggers a waterfall calculation. At that point, a smart contract calls the next layer of committed capital, and the development continues. Improved collateralization. I'm a big fan of this. There's two major issues with how today's capital markets handle real estate. The first is complexity. Commercial real estate is inherently multi-layered. You've got land, improvement, leases, operating businesses within that, the debt instruments, ownership structures. Each layer is valued differently, it's recorded separately, and is updated infrequently. So even small errors can ripple throughout the entire capital stack. And then the second issue is latency. Data takes months to move. Appraisals, rent rolls, financial instruments can lag by quarters. And so most institutions rely on third parties to confirm information. And then you need comparables, which are scarce, inconsistent, and usually outdated by the time that they're used. And so you have this market that's constantly behind reality. And then a third issue is that real estate does not generally have a fail-safe. So if a project stalls or stops, it's dead. You can't bring in new people to finish the job. It's a sunk cost. And so continuing on collateralization, lenders compensate for all of this with very blunt instruments: higher collateralization ratios, higher rates, and restricted reuse. The assets become static. They can't move, they can't be repriced, and they can't support dynamic liquidity. But when you tokenize the verified data, meaning that's real-time, transparent, and tied to performance, the collateral itself becomes dynamic. You can run continuous loan-to-value updates. You can price assets programmatically, and you can build synthetic indices for property pools that share the same data standards. It unlocks capital markets. Last but not least, reclassifying assets. So starting with an example, when high-yield bonds were reclassified, the market grew tenfold and trading activity increased 100-fold. The GAAP classifications under GAAP and FASB, you have 3 levels of fair value, 1, 2, and 3, based off of how observable its inputs are. Level 1, publicly traded, prices are visible. Level 2, derived from observable inputs like comparable trades or benchmarks. And level 3, unobservable estimates, appraisals, internal models. Private real estate sits at level 3. Classification inflates capital requirements. It really puts strain on balance sheets, and it restricts liquidity. It tells investors and regulators that these assets can't be priced properly. And what our research suggests is that blockchain-based information infrastructure can change that. Verified, timestamped, and standardized data, especially when updated continuously, provides the audit trail and transparency needed to move real estate assets closer to level 2 observable, comparable, and marketable. And at this scale, this means a global reclassification event. Properties that were previously uncorrelated, even in different markets or jurisdictions, will have standardized data models, and they will be priced against each other, analyzed side by side, and then traded. I know that was a lot. I think there's multiple recordings of this presentation that will be going out, so you'll be able to find that. That's a QR code to my LinkedIn. Feel free to reach out and continue the conversation, any of the use cases, any of the topic items, building my company branded there in the corner. Or if you need a guest lecture or speaker for your events, don't hesitate to reach out. Thank you again, everyone, and Godspeed.